welcome SafeMoon Army to this educational token.
Oh, I cut you off. I should have
No,
told you
you're
I was playing a video. And right back to it. Where were we? Here we
Awesome.
are.
All right, welcome SafeMoon Army to this educational tokenomics debate between myself and the notorious SafeMoon bear, Ryan Dunn, or NotSafeMoon. Hopefully this debate will help facilitate everyone's understanding of tokenomics and especially automatic liquidity. Ryan has expressed his difference in opinion through his YouTube channel and Twitter. So we're going to see if we can dissect where the differences in logic are. Ryan, do you want to introduce yourself and start us off?
Yeah, my name is Ryan Dunn. I am a big nerd. I've been dealing with cryptocurrency for a long time, since, I don't know, 2010. So maybe Mark was 9 or so back then. But yeah, I'm just a big nerd. I fell in love with SafeMoon originally back in the day when it first came out. Fell in love with the dream, and actually started making a website to track reflections and whatnot, similar to how Mark has his going. And that's kind of when I figured out a few things that operate behind the scenes that didn't totally make sense to me. So yeah, I reached out to the developers of SafeMoon, told them what was going on, what I thought, and they kind of just blew me off, said it was a feature. So then spent a little more time doing some research, making sure that everything that I was looking at was accurate, and then wrote up a technical analysis of what was going on and shared it with Mark about a month ago. And then we've talked back and forth since, but now we're going to talk about it a little more in depth, see what's going on.
Awesome. Yep. So everyone knows my stance on liquidity, on tokenomics. That's all out there in the open. Do you want to start by saying some things you disagree with that I've stated?
Yeah, so basically you talk about how adding liquidity to the pool through this method, the swap and liquefy method, how in the long run it's supposed to be a good idea. And I totally disagree with that, because it brings the value of the token down, and it puts too much of a percentage of the liquidity pool in control of just a handful of people, which is totally against the whole decentralized nature of the whole thing, really.
So do you believe that automatic liquidity overall is a bad thing?
If it's done properly, then no. So to do it properly, there needs to be an external source of the token that you're pairing it with. So in this case, BNB. So that needs to be sourced externally. If it's sourced internally from the same liquidity pool, then anything that you're doing is nullified, because if you take BNB out of a pool and put it right back in with a pair, in the end, the net result is you're only actually adding one of the tokens. You're not adding both.
Okay. And yeah, this is true. Oh, sorry about that. I got a phone call. Not sure why. Okay. So it is true that when you add, the price of an asset in DeFi is calculated as the ratio between the tokens in the liquidity pool. For BNB and SafeMoon, for instance, the more SafeMoon there are compared to BNB, the lower the price, and vice versa.
Right.
But you can't look at it as a cut and dry price goes down, so it's bad. If this function was only negative, why would it be included in the code in the first place? There has to be positives to it, and there are positives to it. There's several positives to it. So the reason why swap and liquefy exists is to increase stability, decrease price volatility. It actually raises our price ceiling. It increases the effects of tokenomics at the expense of a 1% to 2% drop in price. That is what I believe, and I'll go over those a little bit more. But what do you think about that, Ryan?
So I think originally the intention that was behind the idea was excellent, because you do want to add balanced liquidity to the pool. But I think that the execution that SafeMoon and all the other clones are going after, it doesn't actually do it in the way that it was originally intended or advertised to do. So
okay,
yeah.
I combat that with saying if SafeMoon was just a standard trading coin, this would make sense. Having extra unbalanced liquidity would make sense, but we're not. We're a hyper deflationary token with fees. And what that does is it introduces a dwindling liquidity pool. Most other tokens, they have a pretty solid liquidity pool that stays around a similar percentage of the supply with incentives to pair. With hyperdeflationary tokens, there's no incentive to pair liquidity manually because you face a real risk of impermanent loss. So to combat that, we need a way to increase the number of tokens in the LP. And without external BNB, it's not possible to provide a liquidity pair traditionally. So we provide, so we keep the tokens in the BNB in the pool stays the same, and the amount of SafeMoon in the pool increases. While that does lower price, it sets us up to support bull runs. It sets us up to support sell-offs. It sets us up to support many, many things. And I think that we would be doomed without it. I think any deflationary currency without a way to manage its liquidity pool is a ticking time bomb. And soon enough, the LP, not necessarily the LP, but the tokens in the LP will run dry. And when that happens, there's very, very scary results.
When the tokens run dry, well, as there's less tokens in there, the price is just going to keep going up and up and up, and that's how that actually is working.
Sure. If you think of it just from a price perspective, that's one way, but you got to think about it a different way. You got to think about it in the way of volatility, the way of price ceilings, price impact. As tokens in the pool decrease, there is more of an incentive to sell than buy when it hits a certain point. As the tokens in the pool decrease, when you wish to purchase a reasonable amount of tokens, you will be faced with higher and higher price impact as this happens, to the point where it's no longer profitable for you to buy it. You would have to supply, like, to give an example, if you have 1 trillion coins in liquidity and a user tries to purchase 100 billion of them, they will face over 15% price impact, which means they have to pay 15% more BNB to receive the same number of tokens. And this issue scales with how small your liquidity pool becomes. And this is what I define as a price ceiling. Traders will be incentivized to sell at this point or not go anywhere near the buy button. Hyper-deflationary currencies with no way to manage liquidity are doomed to long-term failure due to this price ceiling. Unless you can incentivize some way for a user to provide their own liquidity pairs, but again, that's unlikely due to the impermanent loss we see with deflationary assets. And again, so as the tokens in the pool dwindle down, so does the effects of selling drastically. We call it a rubber band effect. To give an example, say you have a whale that wishes to sell 1 trillion tokens. It doesn't matter how much BNB is in the pool in this instance, because it's defined by ratios. So let's pretend the LP has 10% of the supply of 1 quadrillion, a healthy number, so 100 trillion coins. If a whale sells 1 trillion in this scenario, it'll drop the price by less than 0.5%. But now let's take a step back. Let's say the LP has 1% of the supply, or like 10 trillion tokens. That will drop the price by 8%. And again, let's say the LP continues to deflate down into having 1 trillion tokens left. A whale selling 1 trillion tokens would drop the price by over 50% because it doubles the tokens in the pool. Regardless of what BNB is in there, that doubles the ratio. And if you double the denominator, the fraction is reduced by half. And it's actually a little more than half because of the BNB that gets taken out as well. And so now let's say a whale has 10 trillion tokens. And that's evident. A lot of your whales have more than this. If there's 1 trillion tokens in LP and 10 trillion are sold, the price will drop by more than 92%. And this is what I call a rubber band effect. You can go up and up and up exponentially, but any sell of any sizable amount of tokens will crash the price down with an unrelenting force.
I mean, where are you getting that number from right there?
What number?
You're saying 92%.
Exactly.
It's okay. So you didn't have any other factors in there. You didn't say what the balance of the BNB was in there.
Does it matter?
Yeah, absolutely.
If you have 1 trillion coins over a given amount of BNB, and then you have 11 trillion coins over a less amount of BNB, it is more than 92%. 92% would technically be the lowest that the price could drop. That would be the lower bound. It would drop anywhere from 92% onward.
By putting 10% of the total tokens that are in the pool, you're putting 10% back into it, and you're going to drop the price 92%.
No, say you have 1 trillion tokens in LP, and a whale is selling 10 trillion. That was my final.
Yeah, how many? What was the first number?
1 trillion in LP,
okay,
and a whale sells 10 trillion. It's an exaggerated example, but I continued on down that path.
Right, okay.
I started with reasonable, and I went less and less.
So the whale has 10 times the amount that's in the LP.
Yeah.
Okay, so in what real life situation is that going on?
You can see it in a lot of situations, in many currencies, even in your currency. Well, actually, you provided a lot of LP at the start, a lot of it, and you haven't seen too many voracious bull runs.
Right.
So your LP is in a stable space at this
So
time. That doesn't mean it always will
even
be.
though all of this stuff is going on with SafeMoon adding liquidity to it, and you're saying it's supposed to stabilize things, right now SafeMoon only has about 3.5% BNB available to cover their market cap. So that means of the market cap of everyone's wallet, if everyone tried to cut out at the same time, there's only 3.5% of that market cap sitting there. And that number has been getting worse and worse and worse over time. It has not been getting better and better and better. That number's been getting worse. That is basically the bubble. So you have 3.5% available and 100% market cap, and that number is shrinking. That bubble is getting bigger. And once that pops, all that's going to be left is that 3.5%. But that is shrinking. That's not going up.
Yep. So this is exactly the ratio of your LP to the total supply. That's how you define this ratio of BNB to market cap.
Right.
Because obviously, yeah, the price of the token is defined as that ratio, and you multiply that price by the entire supply, not necessarily just the supply in LP. In your instance, you have 5% liquidity, about 5 or 6. Actually, I don't remember exactly how much liquidity you have. So you have that exact same ratio.
It's closer to, I think it's around 11 or so right now.
11%? Okay. So you have a 1 to 9 backing of your market cap to, of your BNB in your pool to the market cap. This is not an issue necessarily. So you're saying that there's no way that BNB can accumulate in the pool to counteract this addition of tokens, correct?
Not with the way that it's doing it now. No, it has not been. It's been getting worse over time.
Okay. Well, so the effects of buys and sells will throw the liquidity pool as well. So it's not necessarily consistently getting worse. The reason why it gains BNB is due to these fees that accrue. Say if someone is wishing to buy, just for the listeners out there, when you buy a token on a DEX, you put BNB or whatever pairing token it is into a liquidity pool, and you pull the other token out. That's what a buy is. And traditionally, you would get 100% of the tokens, and the BNB would get the pool would get 100% of your BNB. In this scenario with SafeMoon and a 10% tax, you put 100% of the BNB in the token in the pool, but you only get 90% of them back. You can only cash out on 90% of that same BNB that was added in. 5% automatically cashes out due to liquidity, but of the tokens you put in, you can't withdraw all of them. You can't recall them in any way. And the reflections actually help the rest of this. So the reflections send some to the burn wallet, and those can never be recalled. The reflections send some to everyone, including wallets that have been forgotten, including wallets that are accidental. And those the BNB that was paired with those tokens can never be recalled from the pool, which causes a steady increase in the amount of BNB. Now, the whales have been selling, and they've been taking a good amount of BNB. This has been evident.
Now, hold on. Back up. Hold on. So you said when tokens are burned, you're increasing the amount of BNB in the pool. How?
Nope. It's more like you take away the ability to withdraw that BNB, because now the tokens that were traded for it are gone.
Well, no, that's not entirely true either, because the ability to withdraw the BNB still works. The thing that's changing is the market cap is decreasing when you're burning tokens, and that is closing that bubble. So burning tokens is good in that way, but you're not adding any BNB to the pool when you're burning tokens, because you're adding BNB when you swap for the tokens, and then those are burnt afterwards. There's nothing else being added.
No, yeah. I must have. I'm sorry. I'll let you finish. My bad.
No, that was the end, but it just didn't make sense what you had said.
Yeah, I wasn't trying to say that extra BNB is put in on buys. That's not what I said. I said out of the BNB that's put in, the tokens that can recall that BNB are burnt. That raises the price. That raises the ratio of SafeMoon to BNB in this pool.
Raises it in relation to the market cap. So the market cap will lower. The market cap will lower. The available BNB in relation to the market cap will go down.
Market cap is rather arbitrary when you're dealing with liquidity pools. If you wanted to right now, you could create a token with a 10 quadrillion market cap.
Yeah, real easy. You just based off the initial pairing, right?
Yeah, you just put a little bit in, and you have a lot of external supply.
Right.
What's the basis of bringing up market cap and its fluctuations?
So, well, the reason I bring that up is because in all of your videos, that is your main point on why you believe the price of SafeMoon is going to increase over time. Because you have an equation that you put, which is it makes sense, where the price is determined based off of the market cap times the number of tokens. If you bring down the market cap, or if you keep the market cap the same, and you I have the equation of it. I mean, it's really easy. It's
Market cap over supply.
right, exactly. But in all of those videos, you assume that the market cap is going to stay the same when a burn happens. And if that's an assumption that's okay to make, then yes, the price has to go up. I mean, there's no other thing that it can do, because if the market cap stays the same, supply goes down, you do the simple division problem and you have the price. The price is going to go up. But why is that your assumption, that the market cap will not go down during these burns? Because all that's happening when you burn is the market cap goes down. I mean, that is the only effect a burn directly has. It doesn't have a direct effect on price. It has a direct effect on market cap. And what it does, it brings that down.
So after learning, so that was my first video you're referencing, and I never specifically said that burns have an effect or don't have an effect on market cap. I said they have an effect on supply. Market cap, that was more of an elementary overview of it for the listeners. In my liquidity video, I go into much more detail on how price is actually calculated. With DeFi, with Bitcoin, you can use equations like that easily. With DeFi, it can vary. If market cap is it's not the same. It's not what we're used to with stocks. It's not what we're used to with traditional coins.
Right.
So I go more off for price now. I go off of the state of the liquidity pool more so than market cap. Because at the end of the day, you can create an arbitrary market cap. I don't think that with DeFi specifically, I don't think it holds as much value as with other things,
So,
as with coins, as with stocks.
so then explain your argument that if you're burning tokens, the price has to go up. Because that's an argument you've made more than just your first video. So explain that then.
Well, you can't think of, if I burn tokens today, price will go up tomorrow. You think of, if I burn tokens over the course of a year, what will be the net effect? And if there's 10 times fewer tokens than there were before, you can expect there to be an increase in price. That is undeniable.
How? Because the only effect that's
Supply and
happening, those tokens, they're already paid for. So they already made the swap to the pool. Those burnt tokens are already paid for. The price effect has already happened. And then whether those tokens get burnt or sit in the wallet or get transferred to your buddy or whatever, the price is going to be the same. If they get burnt, they're taken out of circulation, the market cap goes down. So where is that coming from? What makes you think that the price is going to go up when there's less?
So
If everyone's holding them,
market cap.
sorry. If everyone's holding their tokens, and if they're being burned, the price is not going to change because there's some being burned. It's just basically another wallet. It might as well just be some guy that they're being sent to.
With the difference being that they cannot be exchanged for BNB again after this point.
Right. Well, let's say you send them to some random super whale that lost his key somewhere, and now this guy's got tons of them, and it's the same thing as it being burnt. It's not going to affect the price. The tokens were already paid for. The effect on the price already happened.
So you're saying if the same amount of demand is maintained and there's less supply, that has no effect to price?
No, that's not what I'm saying.
I don't understand that.
I'm
the
saying
supply
that
is constantly shrinking.
burning tokens has no effect on the price.
Maybe not directly, but indirectly, yes. You can't just apply one equation to something and call the output good. You have to think of how everything interacts together. Taking a step away from liquidity, just looking at supply and demand. There's going to be so many opportunities in the upcoming future to use your SafeMoon in very cool ways. And so there's going to be a demand for it. And if we did not have automatic liquidity, our liquidity would be so much lower to the point that any whale selling out his bag would tank the price an incredible amount. If we did not have automatic liquidity, we could not support bull runs. We could not support any of that. We can't support being an economic powerhouse. We can't support having an exchange where people use SafeMoon to pay gas fees people couldn't purchase it.
And then it's fine for the automatic liquidity to be only built up based off the expense of the people that are swapping the token, even though it's decreasing the price for the ones that they have. And all they're trying to do is close the bubble so that the first guys that got in there can cash out a little easier.
Not necessarily. It doesn't only allow people to cash out easier, it allows cash outs to be less impactful, and it allows other people to have the chance to purchase. And it increases the effect of tokenomics. I've gone over this before as well. Sure, you can say that a lower price is unappealing for a currency, but when that currency increases its rate of burn and reflection for that lower price, it could honestly be seen as a good thing. The burn wallet our burn wallet is hyper deflationary as opposed to yours, which is just deflationary. They both rely on the price though to quantify how many tokens are burned per transaction.
Right.
So you could say that it's bad. You could say, yeah, if it was just a lower price and no other net effect, that would be a bad thing, obviously. But you don't just get that. You get a lower price, you get increased stability, you get all of these things that we're talking, a raised price ceiling. You increase the effects of tokenomics just for a small dip in the price.
You do not increase the effects of the tokenomics. In fact, you totally negate them. So what's actually happening, let's say you buy the token and you hold like everyone says to do, and you're sitting there and you're looking at your number of tokens in your wallet. It's going to go up. No chance in the world it goes down because you're getting reflections. It's going to keep going up, the number of tokens. But let's say the price of the token has stayed stagnant, just works out all the buys, all the sells that day. That just always equals out. The price has been flat. But you're still increasing the number of tokens that you have, right? What's actually happening to the United States dollar value of your tokens in that case? It's going down. You're increasing the number of tokens, and it's not going down right away. What happens is every time you hit one of these swap and liquefy functions, it's dropping enough tokens into the pool to drop the value of your wallet, to drop the value that totally will outweigh the number of reflections that you get. And this is happening from volume at a constant basis. I mean, it's a set number, 500 billion tokens. Once it hits that, then it initiates this function, and the drop to the price, which happens, and it creates these little stair steps in the price, that drop outweighs any reflections that you will ever gain. So over time, if the price of SafeMoon doesn't increase every day by about 1.5%, then the United States dollar value of your wallet is decreasing. And that's 100%.
So you said if price is steady and you're gaining tokens, your value decreases?
Your value will decrease every time one of these swap and liquefy things happens, because the swap and liquefy has a greater effect on the price than the reflections that you're receiving.
Okay. If you're evaluating it on a day-to-day basis, sure.
It doesn't matter how long, because it's going to happen at 500 million tokens every single time. So it doesn't matter. It could happen once. It could happen 1 million times. Every time that it happens, it outweighs all the reflection gains that you made during that time period since the last time it happened.
You're forgetting that with time, this function is going to be called less and less often.
Right, but it's going to have a larger and larger effect on how much it decreases the price over time, because as there's less tokens in the pool, this is still going to drop 500 billion tokens. So its effect is going to increase the drop in price every single time it's used if the price is going up.
The amount it drops the price is directly related to what the supply of the pool is in relation to the total supply. And what we can see is this effect actually increases the supply of the pool in relation to the total supply.
You're increasing the number of tokens in the pool, yeah, but you're decreasing the price, and the price decrease outweighs the reflections gained.
If you're evaluating it day to day,
it doesn't matter how long you evaluate it. You evaluate it for infinity. It's the reflections that you gain, which right now it's 5% distributed for SafeMoon. It's 5% distributed to all holders, which the burn wallet is a holder, so it gets 42% of those reflections right now, and the rest of the amount is split up among all the other holders, and that amount is decreasing, which doesn't matter too much because obviously you're not losing tokens. But anyways, that number is going to be smaller than what the sum of these different dumps to the pool are. So unless there's new people coming in and people are holding and the price is not increasing every single day, your United States dollar value of your wallet, which is really what we actually care about at the end, is going to go down. In fact, if it just stays flat, if the price stays flat except for these dumps that happen, your price is going to go down. For your price to stay, the value of your wallet to stay exactly the same, the price has to increase every single day to offset the devaluation that the dumps call. So it needs to increase more than 1% every single day. Otherwise, the amount of tokens in your wallet will go down. Or sorry, not the number of tokens. The value of the tokens in your wallet will go down.
Okay, so this is assuming that we just have sideways action
No,
for forever.
no, it's assuming any action. That's just the easiest way to picture it in your brain because you don't have to think about the price going up or down. If it's flat, the value is going to go down because the price is going to stair step every time one of these things happen.
So, relating to this, with a hyper-deflationary currency, you need a way to manage liquidity. Saying that you should not manage liquidity at all, it just blows my mind.
That's definitely not what I said. I said that going about it this way is flawed.
Okay, so I disagree. We both have our different interpretations. I think it will increase the rate of burns. It'll increase the rate of reflections. It'll get us to where we're trying to go faster. And with all the things coming out to use SafeMoon, you will need to hold SafeMoon if you want to transact on things. You'll need to purchase SafeMoon to use things. It's not like it's just a coin you're holding and you might sell later, you might sell here, you might sell there. It's not one of those. It doesn't have utility yet, but we're creating utility for it in a way that people will need to purchase this in a way to access all the benefits of Cryptonomics, of all these things. We can't have low liquidity. We can't provide liquidity. We can't incentivize people to provide liquidity. We need a way to increase liquidity, to increase the amount of tokens that people can buy. If you don't plan to ever have a bull run, if you plan to just be a tradable coin that people hold, people sell, you're just a cool DeFi token, you might not need it. You might not need automatic liquidity if you don't expect there to be a need for your token, a genuine need, which is what I believe there will be for SafeMoon in the near future and why we do need this automatic liquidity. With other projects that my friends are in and stuff like that, they very much advertise Swap and Liquify. Useless token, for instance.
Everyone advertises it. It's preposterous, but yeah, continue.
No, yeah, they gave it a name. They tell everyone when it's triggering. We actually try to make it trigger more often. The developers over there will send Useless to the contract just to trigger Sally more and more as liquidity dries up, because it's terrifying, the effects of low liquidity. It's terrifying. It's not that we're just trying to drop the price. They need to raise the liquidity. They need to raise the amount of tokens in liquidity specifically.
So it's not broken, even though you need to manually trigger it to keep increasing the amount of liquidity. It's not broken. It's good.
Nope. They had way more of a bull run than they were expecting. And thank God for Swap and Liquify, or else the problem would have been about 10 times worse. They had such a bull run, actually, that they were just sacrificing tokens just to increase liquidity, to keep it alive, and to avoid this rubber band effect of an increased jump up and then a crashing halt down, which is what will happen when tokens in the LP dry up.
So maybe you can answer a question. So I noticed something that you were working on, doing a little sleuthing on the blockchain like I do, and you were working on a token recently called SafeMoon Support. And in the notes on that token, so last time you submitted this to BSC Scan was a little over 2 weeks ago here, and this is something that you were working on, right? This wasn't someone else's thing?
Nope, I wrote that contract.
Okay, so then maybe you can answer what you were referring to when you said that the goal of this thing was to offset the disadvantages to automatic liquidity, which you put twice in the notes here, that there are negatives with the automatic liquidity. What can you expand on what you meant by that?
Exactly. The exact same negative effect that we both have brought up multiple times now, the slight decrease in price. So what I proposed was matching this Swap and Liquify with a buy and burn mechanism. so they can counteract each other when the time is right. Say the liquidity gets really high, you could buy and burn, and that will reduce the liquidity in the pool. So it's a yin yang. There's 6 liquidity altering operations that a token can utilize. Swap and liquefy is one. So I broke them into categories. There's token addition operations that everyone knows. You can provide liquidity, you can remove liquidity. There are token neutral operations, which is raise the token in the LP and keep the amount of BNB the same, like swap and liquefy. There's you can raise the BNB in the liquidity pool and keep the amount of tokens the same. I call this process reverse swap and liquefy. You can, and then there's 2 token rebalancing operations. You can increase BNB and decrease the tokens, buying, and you can increase the token and decrease the BNB, which is selling. So I proposed adding in a buy and burn mechanism so that we can perfectly control the state of the liquidity pool based on factors that as we need them.
And where are you getting the BNB to initialize these buy and burn operations? Where's that coming from?
That's coming from, well, this was originally a token, but I have recently changed it to not be a token. The token, it would have been from this token. So I abandoned this project a while ago, a long time ago, honestly, just because I felt like there was much better ways of having a better effect than having a token. Because obviously, if you're selling your token and then injecting that BNB into another token, that will just plummet the price of that token. So that was infeasible. That was not. It was an interesting idea. I decided to make the coin hyperinflationary to discourage holding.
Yeah, no,
it's kind of like a yin yang.
I mean, I read through it. It's interesting how you're trying to come up with the different ideas to fix the issue, for sure. I mean, it's definitely that you're.
It wouldn't be fixing the issue. It would be complementing a system to provide complete control over liquidity. This is something that I've been investigating a lot lately, which is stable liquidity, and it's something I've developed with a couple of friends of mine. We're using these 6 liquidity altering operations to keep liquidity at a preferable level. And let me tell you, swap and liquefy is one of the most important functions utilized in that.
So then what, again, would be the source of the BNB if to opt to initialize one of these functions? Then if you aren't doing it as an actual token?
I don't want to give away. All right, whatever. I'll tell you this. Arbitrage.
Okay.
I'll leave it there.
Mm-hmm.
External BNB, dApps, arbitrage, ways to make money from the blockchain based on liquidity pools.
Okay, so some kind of arbitrage bot that just makes a little bit of profit and then handles it. Yeah, makes sense.
That was the original goal. I decided that would be more beneficial than a token, as this token's value would just be plummeting.
Right, right. Yeah.
Constantly. So that's why that idea was abandoned.
Okay. Interesting. Yeah, so then I noticed in a lot of your videos, especially the FUD one, you talk about the constant, the K value, and how in the beginning of the video you say over and over, you say the K value cannot change, the K value can never change, it needs to stay a constant, this is how it works. And with Mark's coin, that I think there's just an example coin that you had.
Yeah.
Let me see. I think I have a screenshot of your video here. Oh, there we go. There we go. Okay, yeah. So you're talking about this is the constant product equation, which is how the liquidity pools operate, so that whenever a swap happens, you put in a certain amount, and the amount that you get out is calculated by keeping the constant value the same after the swap. So that's basically how it's
liquidity pair. You will raise the K value. Calling add liquidity to the Uniswap router in Solidity raises the K value.
Right.
Every time new LP tokens are minted, the K value goes up.
Right. Yes, and it's happening. The way it was designed to happen is you're supposed to be adding an equal value of each token to the pool, so that you're not actually changing the price ratio.
If you're ideally trying to provide one of the token addition operations, sure, but there are many other operations you can do, including swap and liquefy, that are both equally valid. They just have some trade-offs.
Yeah, like decreasing the value of the token more than any reflections that you'll ever receive.
I don't know why you have the reflections weren't supposed to counteract swap and liquefy. That was not the idea of them.
I don't think that the
They're
idea
different.
of the reflection or the idea of swap and liquefy was really anything, because I don't think that the people that came up with this knew what that was or how it worked or anything.
You don't think anyone thought it through?
I mean, it's literally copy and paste. They didn't even take the notes out of the contract from the other token that they copied.
Yep. There were a few tokens that had similar architecture.
Yeah,
And
there's a lot.
several tokens
Lots.
that have swap and liquefy now.
Yeah.
And so you just think they're all flawed. They all have no utility. It's just bad for them overall.
Yes, yes, and it's totally against how DeFi works, because every time that that function operates, it's sending, sometimes in the case of SafeMoon, it's sending $1 million at a time to a privately unlocked wallet. And it's not just SafeMoon. I called it SafeMoon because that was the biggest one at the time, and I mean, it still probably is with these. I called it NotSafeMoon because this is not that. You know, everyone thinks I'm picking fun at SafeMoon and all this. It sounds like it for sure. I chose a very difficult route to say that this is a bad thing. But yeah, I don't see how any benefit can come of this unless you are the person who developed this, or you got in way in the beginning, or because you're getting all the LP tokens then if you're the guy that developed it. I mean,
Or you're someone who wishes to buy in. And about the LP tokens. So you're saying that swap and liquefy just pumps up the developer's bag with LP tokens, correct? I just want to understand you right.
yeah, it absolutely does. Yeah.
Okay. But as you stated before, when swap and liquefy happens, the amount of BNB in the pool stays the same. So when they get these new LP tokens, it's worth the exact same value. In the event of a rug pull, nobody cares how much SafeMoon they have or how many X coin they have. They care about how much BNB they can cash out on. But if BNB is held constant, they don't gain extra funds at all. In fact, the only negative would be a dilution of shares of LP over time. This is why liquidity staking is not preferred. Since all this new liquidity is being added, say there's 1,000 LP tokens in existence and you own 10 of them. That means you are able to pull 1% of the liquidity inside of the pool out,
Right,
in an equal pairing of BNB and token.
right.
Now let's say swap and liquefy calls over and over and over again, and now there's 2,000 LP tokens, and you still own 10.
You only get half a
You
percent.
would now
Right.
only own a 0.5%, exactly.
Right.
So they are not gaining funds from this in any way.
Whoa.
They're
Well, now
it just
hold on.
dilutes.
Hold on. They would be, because if I can only obtain 0.5% at that point, that means that there's 99.5%. Let's say they had 100% of the LP tokens originally, and then I go and I get 10. If they keep getting more LP tokens, then my ratio of the total goes down. Theirs goes up. So yes, they absolutely can pull more out.
That's assuming other people provide liquidity, but they don't provide liquidity because of this reason, because of the impermanent loss and because of the constant dilution of shares. That's why we needed to automatically provide it. If this is why locking tokens is important.
Yeah.
The developers having small access to LP is not a bad thing. Having access to a lot can raise flags, absolutely, especially with undoxed developers and a team.
Even if they're doxxed. Even if they're doxxed. It happens every day.
Sometimes. Well, with yeah, I guess some tokens do have some shady developers, absolutely. I'm not sure why the SafeMoon people wouldn't have gone away running when they had $250 million available. Now they only have about 40 to 50, 60 in LP.
Dang.
Because they've locked the rest. So I'm not sure why. Maybe they. Well, what is your thought? That they were hoping for more?
No, my thought is that it's not a rug pull. It's a thread pull. Because if you notice, if you look at who's selling, it's not a lot of the small holders, because the message is don't sell. But if you do look who's selling, it's the people at the top that have the most tokens. They're selling almost every day.
And this is a bad thing.
Well, I mean, it's only going to work if the little guys don't sell. That way the top guys can keep taking their profits out, and the little guys' value keeps decreasing. The top guys keep pulling out profits from the little guys.
How are they pulling out profits from the little guys?
Because
if a little guy is holding, how is that the case? If anyone sells, you take the profits of people that bought before you.
Yeah,
That's how it goes.
when you sell, the price goes down. So if I'm a new guy coming in and I'm being advertised that there's going to be a 5% gets distributed to all the holders, and then it looks like since I'm a new guy, no, it's actually not that. It's about 2.9% right now. It's getting distributed. I have this small amount. I buy some. I hold it. Great. And then the top guys can now. There's a little more BNB available in the pool because I just bought some, and the top guys they just sell a little bit.
So the fact that the burn wallet is a holder and gains reflections, that's what makes our token hyper deflationary,
Yeah.
opposed to yours, which is just deflationary.
Right.
Saying that your reflections goes down isn't necessarily true. The US dollar value of your reflections stays constant with volume. And I've proved this multiple times.
Okay, yeah, I know everyone on Twitter was going all crazy, and they're totally not getting the message of what I was saying, where it's being advertised that there's 5% being paid back to holders, and that's just incorrect because it's not that. It's 2.9%, and that amount is decreasing. I was never talking about anyone's single specific wallet. I was talking about holders, like in general. I know that if you have 1,000 tokens and the burn wallet gets more and more tokens, I know that I'm not going to have all of a sudden 999 tokens. I know that was never the argument that everyone started going crazy about. Just, thought I should mention that because that's what kind of it seemed like people were going at.
Yeah, no, that wasn't the argument I was trying to make either. You don't lose tokens or value. All I'm saying is that the value, if you're selling your reflections on a daily basis, which is what's advertised to do with SafeMoon, when you get to a viable point, you should be selling off your reflections. That is completely fine. That's what I've been saying, at least. That's my preferred methodology. If you're selling your reflections on a daily basis and the USD value of your reflections is the same, it doesn't matter how many arbitrary SafeMoon tokens you get. If 5% is paid to all holders, that's fine. The burn wallet is a holder. It's all public key addresses. If what that adds to the token is it adds a hyper deflationary aspect. We will burn our tokens faster due to this. And even if the burn wallet holds 99% of the supply, you'll gain the same USD value of your reflections back every day. It doesn't matter. It could own 99.99999% of the supply. You'd get the same USD value of your reflections back.
Right, yeah, you'll keep getting the same US dollar value of reflections back, and then one day it'll hit the swap and liquefy, and then all of a sudden your total bag value is worth less than it was before the swap and liquefy, and your reflections will never catch up with how much swap and liquefy devalues it.
Except for the point of when you consider the price ceiling of that exists without swap and liquefy.
Go ahead and
Without
expand that. Expand on that.
With a hyperdeflationary currency, we've noticed, and it's commonly known that the liquidity pool will decrease with time. With any side of sideways trading, not necessarily, obviously, if everyone sells, the liquidity will go up. But assuming sideways trading, the liquidity pool diminishes over time without swap and liquefy. This is true. And this is where the price ceiling comes into play. Because of price impact, that's the main thing. When you get to such a low amount of tokens in the pool, it will not be worth it for someone to buy. If someone has to spend B&Bs on B&Bs to get like a couple million tokens comparatively to the rest, it just won't be viable. They won't even want to. It won't even if the price is skyrocketing, if they have to lose all that money, it's going to incentivize sells way more than buys. If you're looking at spending 25% extra money for the same market value that you would have without spending extra 25%, people won't do that.
So it's bad.
That is not.
So it's bad for the price to go up because the tokens become more expensive. That's what you're saying.
Nope, I'm saying it's bad for liquidity to run low because it creates a rubber band elastic effect with a defined price ceiling.
Price is calculated based off of the liquidity. So when there is less tokens in the pool, price goes up.
That's a very cut and dry way to think about it, right?
I mean, it's a very true mathematical. This is math. It has nothing to do with assumptions. It has nothing to do with feelings. It has nothing to do with my hopes and dreams. It has nothing to do with advertisements. It just has to do with the hard facts and the math of what is actually happening. The price is going
down. X over Y. Yep, price equals X over Y. Except for the fact that in a situation with low liquidity, a sale that does happen will tank the price exponentially more. It's volatility that matters more than price in this scenario, especially when you're trying to set yourself up to be a token used by everyone, by around the world, in the Gambia, everywhere.
So then
you need liquidity.
So then
liquidity is necessary.
Why set up the token originally to have such a small percentage to cover the market cap? I mean, what's the point of that? It's so that the people that started it in the beginning, all of a sudden theirs is worth just a substantial amount of money when the thing starts out. and it's just going to keep growing. I mean, what's the point of only having 3% and that number's going down, have 3% cover the market cap? What's the point of even setting it up like that? So ours started at 10 and it's going up over time as it's supposed to, and it's at like 11 or something right now.
That just means you don't have much demand on your token, man. Sorry.
Yeah, I don't have any advertising or any of that stuff. That's totally fine. I didn't go about this for that.
Demand, if you expect a bull run, that's when you should start caring about liquidity. If all of a sudden people just start flocking to your token and buying it by the dozens, it'll get to a point where one tiny sell will mitigate all of those buys from all of those people who spent their money trying to FOMO in and catch the bull run. One dude is going to be able to just cash out and sink the price back down, taking all of their money.
Yeah, and right now, the effect on SafeMoon for that happening is just substantially more. So I don't really know what you're trying to turn it around.
No, you probably started your liquidity pool with a lot more than SafeMoon did originally.
And it's increasing over time.
People are selling. That's what that means. When people sell, your liquidity pool increases.
Yeah, the total number of tokens in there, but I'm talking about the ratio between the market cap and the available BNB.
So that's defined by the number of tokens again, because that's what matters, because that you get that price and you multiply it by the total supply, and that's what inflates it by X percentage. Even though the BNB is what the actual value is based off of. If you have 1% liquidity in your pool, then it reflects 1% of the market cap, roughly.
Right.
So adding liquidity will mitigate this. We'll have the reverse effect.
At the expense of all the wallet holders that are just now starting to buy.
How is that not what happens with low liquidity if you don't add liquidity? When the price hits a price ceiling and one small sell from one whale will tank the price down dramatically. Is that not screwing all the little guys?
What do you mean when you're saying price ceiling? You just mean like at an all-time high?
Nope. What I mean is it gets to a point where the price impact is so high to purchase that selling becomes incentivized.
Yeah, that's just how it works. Prices go up, things become more expensive, people want to buy less.
Price impact isn't how it's supposed to work, man. Price impact is literally it saying because of the constant product formula, you have to provide more money than the market share. So if the normal price was X cents, you have to pay 15, 25, 30% more than that, even though it'll still be worth X cents at the end. That's what price impact is. And you see it all the time with low liquidity coins. It's the main killer of low liquidity coins is the price impact and the fact that it is now not optimal to purchase this. It doesn't make sense. You have to bank on the price increasing again by that price impact amount to ever see a profit. And even more so if you're factoring sale and buy fees.
Yeah, which is just not going to happen when Swap and Liquify is dumping tokens into the pool at a rate higher than any reflections will ever give you.
I mean, you're still relating reflections and liquidity as if they're supposed to counteract each other.
Well,
that was never the goal.
I mean, the idea with the reflections is that you hold and you make money. I mean, that's the idea. Is it not? Isn't that the idea?
That is the idea.
Right.
Yes.
Okay. So but with SafeMoon, because of Swap and Liquify, when you hold, you are losing money because of these dumps, and that is a fact. Because the idea is hold, and you're going to get paid from reflections, and you're going to make money. That's the idea. That is not true, because if you hold and Swap and Liquify does what it does, your US dollar value of your wallet will go down no matter what, because the amount of reflections that you gain it's always going to be less than what the Swap and Liquify will decrease it by. Unless SafeMoon changes a lot of the functions and a lot of the features and a lot of the percentages, that is the reality of it. You're going to lose value if you hold unless the price increases at least every day by a little over 1%. And that's the truth.
Except for the fact that this decrease in price hyper increases the rate of burns and the rate of reflections. And if there ever is, and when there is a scenario where supply meets demand in an unreal way, and there is an increase in bull run, that's when you gained more reflections in arbitrary SafeMoon tokens, sure. And if you don't sell, that's when you realize the benefit. Because say the price is X and you earn a million tokens, and then the price is 1/10 of X, you would earn 10 million tokens. If the price
If the
ever
volume was the same,
returns to X,
if the volume was the same, but you can't assume the volume, or sorry, you can't assume the market cap is going to stay the same. That's not. You just can't make
volume
these
or market
assumptions.
cap?
Both. You can't make any of these assumptions. Just because the price changes, you can't say that.
So
You can't make that assumption.
Well, one more time? Just outline that assumption for me. I just want to be on the same page as you.
Everything that you've been saying requires these assumptions where certain things stay the same. Either it's market cap or volume or whatever. And you always throw one of these variables in there where, okay, we can say this is going to be the same, and then XYZ, and then you're going to be rich. I mean, you can't just keep throwing in one of these things, one of these assumptions that doesn't have any basis in reality because it works out to give you a profit in the end. It doesn't make sense.
So when I evaluate volume as constant, that's to show parallels between different circumstances, such as burn wallet size, such as XYZ.
Sure.
It's not that I'm saying volume has to be constant for any of this to happen. Any of this will just be varied by the amount of volume. I don't understand how that's an assumption. It's an example.
Right, but
it's an example so people can follow along.
Yeah, but you're creating these examples not based on how it actually works. You're creating them so that the math equation, which you do and is correct, sorry, my headphones just told me a low battery. Can you still hear me? Sorry.
Yeah, I can hear you.
All right, I've totally forgot what I was doing. Yeah, my headphone lady started yelling at me to recharge it. I don't even, where was I just going?
Honestly,
just jolting me out. Yeah, I know you don't know. Anyways, that's what
you're just saying the same stuff over and over.
And that's what really grinds my gears.
Huh. All right.
God.
Okay. So to sum it all up, you think that I'm curious to see what the people listening think. I'm locked into this screen right now, and I don't really have time to read through the comments, but I'm interested.
I haven't even looked at them.
I'm interested to see what the people think about.
Oh, I've got another thing. Yeah, I am too, actually. But I've got a couple more questions for you.
Sure.
While I got you here, so we've got. So I pulled up your website. Looking at some of these reflection tracking deals. I was just curious, where are you pulling these numbers from?
That's just based off the APY.
So, like the amount burned, like where's that come from?
Well, so that would be the amount burned if centralized exchanges had tokenomics on them. And I say that at the bottom if you scroll down. Mm-hmm. Go to the calculator section.
Right, yeah. No, I did read that on there, yeah.
Yep, so that was a disclaimer. I'm not hiding anything there. That would be the amount burned for the current price and the current volume if when phase 2 tokenomics is implemented.
Okay, so basically you're making an assumption that this would be the burn if the situation was not reality. So this is what I'm saying when I say you're calculating things based off assumptions because it works out better for the math. The answer is more in your favor when you make these assumptions like that. Because the reality of it is the different exchanges aren't contributing to the tokenomics, and none of the tokens that are being swapped on the other chains are contributing to the tokenomics, and none of those are being burnt. When you actually pull up the actual numbers, so this is not using math, this is just straight up asking the blockchain, what is the balance of the burn wallet at this block? What is the balance of the burn wallet at that block? That is literally all that this is. And today we burned 25.6. I threw this together real quick. It says undefined while it's pulling data, but and then you're saying 106 because that's based off of assumptions that aren't real, and that won't be real. You're saying in 7 days 892 billion tokens. Well, in 7 days, what was the actual number? In 7 days, the actual number was 296. So you're coming up with all of these calculations based off of things that aren't real because the exchanges don't contribute to tokenomics on PancakeSwap.
Yet.
Okay.
They do not yet. So if you wanted to get the exact, so I put a disclaimer saying that this will be the values when phase 2 tokenomics is out. And you have an ability, if you click the calculator button, just do it.
Yeah, let's do it.
Click calculator.
Mm-hmm.
Now click burn. Go up, click reflection.
Mm-hmm.
And now you can put in the volume for the exchange you hold on. And you can expect to see what you expect to see.
How long
So
until 1
I
trillion?
opened it up.
Where'd you get this from? How long till 1 trillion left?
Yep, it has to do with the compounding interest equation. A equals P times 1 plus rate times raised to the NT.
Yeah, to the n. Yeah.
So yeah, you take the log of both sides, isolate T. That's assuming constant still.
Right.
So
Assuming, right. The lot.
so that's assuming if the price stays low, which, as we see, will not happen as volume increases.
No? Oh.
Try to kick up the volume. Try to kick up the volume a little bit. See what happens.
Yeah.
You're telling me that with volume, price would be low, given just to type in 130 million. You know, just add a zero there.
What was it at? 13?
Yeah.
Burn per day.
Solid.
Yeah, burn per day. Okay. Yeah, but
Okay.
the burns are never actually at this, though. In one of your videos, you say the burns have been 4.7 trillion on one day, which I think that was at the very maximum volume days that you were talking about that. But I mean, the burns have never been anywhere near that in reality. They've never been anywhere close. I mean, even
We've had multiple days where we've burned over a trillion, actually. I've been a holder since day 4. I've been following this very closely.
Okay. In the very beginning, they burned, whatever it was, 40 trillion at once or whatever. Or what was the first number? 45? I can't remember.
They start. I'm not sure exactly, but they started with 277 trillion coins in the burn wallet. So
Okay.
to assume that we've gotten
Okay,
to this
right,
point
right.
without having a trillion per day, even though it's been only a few months, doesn't make sense. We must have burned more than a trillion per day for multiple days.
Okay.
Unless it was all manually done, but that many coins weren't manually burnt in retrospect.
And then right now, they're burning, nowhere near that. It's 25 billion today.
Yep.
Yeah.
We have no products out. Right now we're just a token on BEP. We're a BEP20 token. That is the limit of us right now. So you can't expect to see crazy high volume. We went viral that day. That's what brought the volume. We're not banking on going viral to bring more volume in the future. We're banking on utility.
Okay. How about some logical price predictions? That was a good one. A good video. So here's your logical price predictions. Do you still think a lot of these things are going to make sense?
I can't comment on price technically. I can comment on it. I can't say if those are what I think it's going to be just legally, but I am confident in some of those figures. Yes.
Okay. Well, here it is graphed out. So the blue line is the current down here in the very bottom corner. That is the entirety of the SafeMoon price chart. So that's it. So it's flat here when we zoom out with these assumptions or these logical price estimates. So we have the red line. That's your what do you call it? Your modest, right? Your modest, and then your probable, and then your moon. But this is too confusing. So let's zoom in a little bit. So your moon estimate, it looks a little more preposterous here, but yeah, okay.
I never said
the red line looks like it
it's
could.
called a moon estimate for a
Yeah,
reason.
the red line looks like it can make a little sense, but let's zoom in a little more. And okay, so here's the blue line. That's the date that you made that logical price estimate for the future here. So the orange line is your moon estimate. Yeah, let's zoom in a little more. So here's just the end of 20.
Are you going for? Are you using my 3-year value?
So it's both. So you did. So this first white line is the end of this year. So that was your first guess, and then the end of 2024. Notice how it changes slope here.
I'm just wondering which specific prices you are.
All of them. They're all on here. They're all on here.
Okay.
Yeah, you have your modest is the red line, and it has your estimate up to the year 2022, and then it changes slope for your next estimate.
Those?
Yeah, I mean the thing would be a little.
So you related the two.
Yeah, it would be steeper. Obviously, you would go from this top corner a straight line to here if it was just the single. But yeah. But
okay. So,
I mean, you still think that this is going to be the
point.
modest price estimate for this year, though? You're still pretty confident that the price. I mean, look at this moon thing. I mean, how can you think that that's a logical price estimate? It's literally a vertical line.
Over time, man. I can't wait. I can't wait for our products to come out.
I hope it does. I hope that this happens because this would be amazing. This would be.
It does look pretty funny graphed out. I'll give you that.
Yeah, I mean, it's in reality when you actually look at it and see what it means on the big picture. It's.
Okay, say what you will. I'm absolutely bullish on SafeMoon, and the moon prediction wasn't supposed to be verbatim. That was given everything goes incredibly well, and we have an insane amount of success. I basically amped that up in the thing. I would more follow the likely one, so the middle one.
The yellow one. Okay, yeah. So it's following pretty close to that right now.
Again, we're a BEP20 token with 0 products out.
Yeah. No.
I don't know it's not expected to moon like this when there's no products out. That wouldn't make sense unless, again, we went viral or something like that. I don't expect anything. I don't expect $1 billion of volume until we have an exchange, until we have a blockchain.
But you would expect the value of people's wallets to be increasing, like the United States dollar value.
When we do have these things, sure. In terms of day-to-day price action, I have no idea.
I do. I have an idea. Basically, the swap and liquefy will never outweigh the reflections that you gain.
Sure, but using the token in utility and increasing the rate of burn will, in my belief.
Increasing the rate of burn has no effect on price. It only has effect on market cap. The direct effect is a lower market cap.
In the short term, sure. And you keep saying in the long term it's the same thing, but you can't tell me that when you burn down an asset, when an asset is continuously decreasing, that its price would never find a point to where the demand outweighs the supply. That's what I don't understand. How you don't think that that is ever going to happen.
Well, I'm not making an assumption. I'm just basing it off of reality. And you've been burning a lot of tokens with this. But yeah, I don't know. It's not following these lines very well, I guess.
Not yet. Nope. Again, no products have been released. I don't expect those lines to be necessarily followed until we see some sort of tangible asset.
Well,
namely,
I'm excited.
I'm the most excited for the blockchain. There's a lot of innovation coming there.
I'm excited to see your next logical price analysis.
Sadly, I can't make them anymore as long as I'm on the team.
NDAs, bro. NDAs. Can't talk about that.
I just can't talk about price.
I'm not a financial analyst.
I could be liable for people saying, "Oh, he's on the team and he said it was going to go here."
Yeah, your belief is that it's going to go up for sure.
Yeah, I definitely am very bullish on the longevity of SafeMoon. So, this has been it seems we've been dancing in circles. So we might as well, unless you have any more questions, we might as well leave it up to other people to infer what they believe based on the facts we provided. Do you have anything else to add? I feel as if I'm confident with all of my answers.
Yeah, I mean, I knew we weren't going to reach any kind of resolution with much. It was just going to be.
No, I respect your opinion.
I'm interested in seeing what is going to come up. You know, there's a lot of reserves that SafeMoon has. You know, so they could have a lot of. There's a lot of resources available for things to be fixed and for new stuff to come out. Interested to see where it goes, but I mean, I still hold the belief that the math shows that over time, the value of the wallet amount is going to decrease because of the swap and liquefy effect. It will always outweigh reflections to the point where it is impossible without a constant flow of new buyers and a constant flow of new money coming in. The value of the wallet is going to decrease.
I respect your opinion. I firmly love swap and liquefy. I wish if it were up to me, I would raise that percentage by a good amount.
Do it. Call up one of the dudes. Call up the dude that is in charge of the token. Raise that percentage. Pump that baby up.
Yep. Like you said before, SafeMoon's liquidity pool is not that high. We experienced a pretty ridiculously sized bull run, and it drained our liquidity. So if there was a way to easily, well, there is a way. You could just change the values, but without pissing people off. If there was a way to easily just increase that until it reached a steady threshold and then drop it back down to normal, I feel like that would be only beneficial to the token. Maybe in the short term, your value of your bag would decrease, but it won't get sunk the first time a whale decides to sell. It won't get sunk by 92%. To give that to rehash that one estimate.
Yeah. I'm not saying that it's going to. I'm just saying that over time, holding will only increase the dollar value of your wallet if there's a constant stream of new buyers coming in, which sounds a little.
Doesn't have to be new buyers.
It needs to be
SafeMoon
new
will be the
buys. Needs to
fuel.
be new buys.
Yep, SafeMoon will be the fuel. SafeMoon, you will, it'll be necessary for you to purchase and use your SafeMoon to interact with everything that they have coming. If it wasn't easy to purchase it, if you had to face high price impacts, that system falls apart entirely.
Interesting.
If you're planning to be, if you have goals like this, if you're building not only just a BEP20 token, but an ecosystem where you need to use SafeMoon, you need to purchase it and use it. Say you're moving Dogecoin over to the exchange to gain Cryptonomics. You can either pay like a flat fee in Dogecoin, say 2.5%, or you'd be able to pay a 1% fee in SafeMoon and avoid it altogether. Things like this, it will require a constant purchasing of SafeMoon to interact with the platforms. So I personally don't see having new buys being an issue once our products are out.
It's a good thing.
And without swap and liquefy, we would be in such a worse position.
And it's a good thing that there will be a lot of new uses for it, because without that, the value of your wallet will continue to decrease.
So yeah, so here's a good takeaway, which maybe will make both people happy. If you're planning on forking SafeMoon, and you plan on being strictly a BEP20 token for just the hell of tokenomics, why not? You know, people are going to buy it, people are going to sell it. This system isn't perfect for you. If you're planning to change the world, if you're planning to incorporate yourself globally and have an ecosystem built off of using this token as the fuel, then it is absolutely necessary to have automatic liquidity. That's my belief.
Well, then I guess we will have to agree to disagree, sir.
Yes, sir. It's been a pleasure talking with you, though, Ron.
Yeah,
this has been a good day.
I did too. Let's do it again sometime.
I'm down for that. You wanna? How about in like 6 months or a year or something? We can see what we thought, see what went right, see what went wrong, and discuss it again, perhaps.
Things change quickly. Let's do it sooner.
I would rather wait till instead of just speculating on projects that haven't come out yet, I would rather see the effects of when a product comes out, such as the exchange. See how it interacts, and if it's similar to the way I was thinking, or if it's similar to the way you were thinking. I feel like that would be more beneficial, so we have more tangible proof as opposed to just talking hypothetically.
Okay.
If that's okay with you.
Yeah, I mean, sure. If you want to, get some more stuff to prove the points, then that makes sense. I get it.
Yeah, well, I mean, it's not necessarily prove the points. It's more like I'm saying that with the introduction of exchanges and blockchains, that all of this will be mitigated, all of this negative effects. So we need to see if that's actually the case or not. So if that's okay for you, how about like 2 months after the exchange launches?
Yeah, just whenever. I'll do it whenever. I'm down to talk to everybody. Right, and if your big guys want to talk too, I'll talk to them too. Let them know.
Okay. No, yeah, for sure.
I've been putting that out there to talk to a lot of people. Only a handful of like other token people have talked to me, and then one of them ended up rugging his token right after he talked to me, so that was interesting.
Damn.
Yeah, which I don't know. Things happen.
All right. Well, thank you guys for watching, everyone. I'm SafeMoon Mark. That's not SafeMoon. We have our differences in opinion, but at the end of the day, it's up to you guys to decide what you think overall.
Yeah. And hi, I'm Ryan Dunn. Adios.
Goodbye, guys.